name is Fernando Zapatero. I'm a professor, Richard Cohen Professor of Management at the Business School. I'm also the department chair of the Finance Department. That's my field of expertise. I've been working especially on asset markets and lately asset management, also behavioral finance. For the last few years, a lot of my research, and I'm right now actually completing a textbook on behavioral finance. We knew about COVID for a few months. I came from October, November last year in China, and there was a possibility that this will spread out. So there was already some uncertainty, but I think no one was expecting that the pandemic will hit the rest of the world, particularly the US, so the rest of the world, so hard, so fast. So when in March, authorities realized that the disease is spreading and it's spreading very fast, and they decided, okay, we have to take some strong measures, and we locked down the economy. Then there were two factors there. One was the uncertainty. What is happening? Where is this going to go? I mean, how are we going to fight this problem? And two, the economy was shut down. And so many businesses basically disappeared or went on suspension overnight. So there were the two effects. One was the uncertainty. We don't know what is going on. Uncertainty is not good because financial markets work on planning or trying to project what the future is going to be like and discounting the future. And if there's uncertainty, that becomes a much harder exercise, of course, and that takes an effect. Has a negative effect on the markets. But then there was also the real effect of the economy, the real economy. Financial markets are related to the real economy. I'll have more to say about that later, maybe, are related to the real economy, and the real economy now is becoming to stop. There were two big difference here about the real economy. One was the economy was stopped to a halt overnight in some sort of artificial way. This was a decision, or the right decision, by the authorities, unless something that was happening as an equilibrium in the market was something that was imposed. Two, very important, and this is one of the big differences of this crisis, the economic effects were not symmetric, were not uniform. They're never completely uniform. In 2008, financial institutions and the financial side of the economy was more directly affected, but there was an overflow. I mean, at the end, everyone suffered effects. In this case, some parts of the economy, hospitality, airlines, anything related to travel, education, retail, anything that has to do with retail shopping, anything that has to do with face-to-face interaction was hit very hard, while some other parts of the economy, in fact, boom. For example, one big one that is having a big impact in the dynamics of markets is the huge increase in retail investing in markets. Traditionally, and that has been a secular trend, less and less of the market trade and the purchase of stock in public markets has been due to individual investors. I mean, these days, or for the last decades, more and more it's been the most of the trade was due to activity of mutual funds, hedge funds, pension plans, big institutional investors. There's also some discretionary money. I mean, I think the Fed and the Treasury Department did what, the House, they did what they had to do, the Congress, they had to do in terms of helping people, especially unemployed people. But some people found themselves with some discretionary money that they thought, well, maybe I can use some of it to invest in the market. I think the way companies are evaluated in financial markets is new, is unique. So there has been always, of course, valuation is not a perfect science, but there has been always some understanding and some common grounds people will agree on why a company is worth more than B. But right now, a lot of the valuation depends on how people feel about the company, and sometimes you see, well, this doesn't have anything to do with what we call the fundamentals in valuation, and that's because what individuals care is they like the company, they see what other people are thinking about the company. What are the fundamentals? That's irrelevant. If other people like the company are buying the company, that's good enough. There's still going to be uncertainty because one problem is, obviously we all were begging for the day when they will announce a vaccine is approved and people start getting vaccinated, but we don't know this. That adds another layer of uncertainty in the sense that we don't know how long this is going to take. We all read the same press. There's uncertainties on how fast is this going to be distributed, how many people are going to resist taking the vaccine, and what type of problems that is going to create, and so on. So there's a layer of uncertainty. We don't know what the economy is going to look like at the end of COVID, but we think that it's not going to be the same as it was before. How this is going to affect companies, we don't know. So there are some companies that have benefited and probably are going to still benefit. Some might be suffering for the long term, like retailing or partially hospitality, maybe airlines, but we still cannot tell which ones will be the winners, which one will be the losers 100%.